That's just one of the hundreds of things. That guy's like a soundbite machine. You know, I put this like so well that it's really a flashback. See, that's something that bothers me. That really put it in more perspective. I've been so intrigued with reading all kinds of stuff. It's like extreme hours. A lot of these explanations that come out of really pent up aggression towards the whole. It's definitely.
Okay, thank you. Let's start.
Showed up to in this case, it's nice. Any other?
Yeah, well, we got
So you
May I get your
will
attention?
Cyprus too? December 8th. December 8th, they have a big
I'm in now.
December 8th.
Are you going to stand up with it?
I think so, because I have to do this.
All right, can I get your
You're
attention?
welcome
We're
to.
running a little bit late here. And next, Mark. Everybody coming back over there. This is a very good session. I am proud to introduce two of my good friends that I can call them friend, Mark Roderick and Greg Denlinger. Greg is basically a crowdfund CPA. 5 years ago, he phoned me and he said, what's going on about crowdfunding, anybody? And he was at the time, he was working with another firm with their article. And we started the company and all the due diligence, everything that has been done in crowdfunding. But he's been in a lot of conferences and we get a lot of articles in crowdfunding. And but he's a real deal out of the Denver operate. So he's the crowdfund CPA. Mark Roderick is one of the leader of I can say as a leader of the crowdfunding space, and has been writing a lot of articles. Mark's website has a lot of information. He writes for crowdfunding. If you go to his website, if you go to our crowdfunding or OTC marketplace, you can get a lot of information. He explained everything in a very, in a very delicate way. That what's a tier 1, tier 2. So I just go time to time, I look at your website and I look at what you wrote about, what you have done, mostly academically in this. And I'm grateful to have there. So I give it to you, gentlemen. Thank you.
Okay. Thank you, Sydney, and thank you for putting this event together. Your events are always terrific. Okay, so what we're mainly going to have to do today is just, correct all the misconceptions that Doug Ellenoff left you with.
He's left the room.
Yeah, he's left the room. Too bad. Okay, we're actually going to talk about the mechanics of preparing and filing a Form 1A, which is just incredibly fascinating. And Craig, as sort of the accountant in the Regulation A space, how many Regulation A offerings have you and are you involved with? Have you been involved with every one that has been filed?
Probably about 30.
30. So Craig, 30, that's a lot. Craig is going to talk about the accounting requirements under Regulation A, both Tier 1 and Tier 2. Before we start that, I'm not going to go through these, but as Sydney says, I have a blog, and my blog is not a marketing blog. It's resources for our industry, and I just want to point out 4 resources, not for you to read now, but if you're interested in learning more, that you might want to take a look at. The first is this very short summary of Regulation A. This is a short summary. The other is, if I can put on my glasses, this is a summary, but a much more in-depth summary. So this goes into all the rules. I try to write in a non-lawyer, that is to say, readable.
This is all on your blog?
Yes. So these are all resources. Again, you're not going to look at it today, but goes through all of the stuff in Tier 1 and Tier 2 and how all the laws work and all the resales and everything. So those are two legal things. And then there's also, and this is very important, there's this timeline. Now, you don't want to print this because it's too big. But if you expand this, as you see, can you see that at all in the back? So there. So this is a timeline for preparing for and filing and having qualified a typical Regulation A offering. And all the people that you have to get involved and how long things take and what you should expect. So it's a whole visual encapsulation of what Regulation A issuers should be involved with. You will notice, per the previous panel, that there's this blue line goes all the way across marketing, 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 because that's what this industry is about. Crowdfunding is a marketing business. And finally, I put together this little piece assembling the team for a Regulation A offering. So who needs to be involved and how much each person, what each person does and how much approximately each person costs. So, of course, the two questions that everyone in this room who's in the space gets asked immediately is how long does it take, how much does it cost? So these two graphics pieces are intended to answer those questions to the extent they can be answered. So we have lawyer, the platform, and I've tried to estimate costs. My caveat about this piece, which I say at the outset, is this industry is growing so quickly and changing so quickly that, a week from now, those numbers will be wrong and the players will be somewhat wrong because everyone in the industry, other than the lawyers and accountants, is trying to vertically integrate. Platforms want to become fund managers and fund managers want to become platforms and people want to affiliate with broker dealers because obviously once you're in the space and you get the customer, you want to keep the customer for as much of the process as is possible. So roles are changing and costs are changing. Costs are basically all coming down. But anyway, so now stop looking at that. But so those are 4 resources if you really want to delve in more deeply to the Regulation A process. My next one is actually I'm going to post a list of providers of each of these services. So if you'd like to be on that, and my marketing group at my law firm they're going crazy because I'm going to list other lawyers too. I think it's good for the industry to have full transparency, a place where you can go and say, okay, what are my choices for lawyers? I got to find a second accountant. It's going to look like, but where I can go for platforms so it can be an additional resource for the industry. So that's coming up next. All right, so now let's, and before we go further, of course, we have a nice small room here, compact room. Presentations are always better when they're conversations. So if you have questions or you want to make a comment or Sam wants to point out something I'm saying that's wrong, please feel free. Okay, I've been talking enough now. So Craig, why don't you tell us all about the accounting for a Regulation A offering?
So from the accounting side of Regulation A offering is, it's a cumbersome process. It's an SEC filing, so your QuickBooks reports that you currently have or less aren't where you need to be, and it generally involves multiple CPA firms depending on the complexity of the company. Most accounting firms aren't familiar with the SEC financial statements, and so you got to get those prepared in that manner, and then off to the second CPA under the independent standards to get the audit done for new shell companies. For new shell companies, it's a little different.
This microphone is taped to the thing. Doesn't work?
It's not going to speakers, so.
Oh, but
I'll speak up. So to get the financial statements ready for the SEC offering, you gotta first get it all prepared up into the SEC form, full GAAP financial statements, and the footnotes that go along with that. So things like stock options make that very complicated. It's things not many CPAs deal with. So assembling the team is kind of an important first step in the process, getting the right people in place that are able to prepare these things the way they need to be. And then going through the audit process is, I'd love to tell you it's easy, it is not. A lot of old documentation needs to be dug up from day one forward and gone through all the testing and stuff. In general, depending on the complexity of the company, these take anywhere from 2-3 weeks to a month or two to get through the audit process. And the auditors are tending to work with the lawyers as they're working through their stuff, so it's kind of a simultaneous process there. And once you get through the audit, then there's another report the CPAs need to be involved with, a consent report, which involves reviewing the circular for all the financial pieces of that and everything affecting the capitalization table and that sort of thing. That's kind of the role of the accountant in the whole process.
so Tier 1 versus Tier 2. Have you done any Tier 1 offerings?
We've talked about this before, that Tier 1 is not generally a good alternative. There's some exceptions to that, but generally it doesn't get you out of the audit requirement, because then when you go to the states, unless you happen to only be raising in a couple states that don't have their own audit requirement, the states generally require the audit anyway.
Okay, so you're doing audits for all of the
Yeah, Tier 1 or Tier 2, but the ones that have started Tier 1 have generally ended up switching to Tier 2 when they see the state review process.
Can you talk, so we submit the Form 1A and the SEC comes back with comments. Do you typically get a lot of comments back from the SEC about the financial statements? And if so, what are the areas that the SEC seems concerned with?
The SEC leaves the financial statements alone unless there's something major the accountant missed. So if the accountant did their job right, it's generally okay. And I've rarely had any changes to anything in the financial statements. Where we see financial statement comments financial comments is generally with the MD&A, management discussion analysis section, which is kind of an informal, high-level overview of the company, where the SEC will have comments of, we see this in your financials, why are you not discussing it in your MD&A, and that sort of thing. So it's really, to avoid that type of comment, you need to really understand your financial situation, what investors are going to be looking at in there. That's the types of comments the SEC tends to put in.
Okay, so now I'm going to talk a little about the Form 1A itself, which the lawyer and the company put together, and how that process goes and what to expect. I guess I also wanted to make one general comment to follow up some of the discussion this morning. So this whole Regulation A space, it can be a lot of different things. And depending on what world you live in, you tend to see Regulation A differently. So, for example, many of the people in this room who are in the crowdfunding space were in Las Vegas 2 or 3 weeks ago, and that conference was a combination of Kickstarter kind of crowdfunding together with equity crowdfunding. And so the people there, if you came to it from that world, it was sort of, well, isn't what we're talking about now, isn't Regulation A just another kind of Kickstarter, except you get stock also? In addition to a free t-shirt, you get stock. I mean, I'm serious. And we had people in the audience, it was like a revival meeting. Revival, is that what it's called? Yeah, you know, people standing up in the audience talking about, I want to tell this story. You know, I was down in the dumps, I couldn't get funding for my company, and then I used crowdfunding and you know, like weeping. But I'm only half joking for those. So that was that world, okay? Then there's a world, the real estate world. And if you're in the real estate private placement world, Regulation A just looks like a big private placement. And what's the big deal, right? And so, I mean, I think what's going to happen to Regulation A, it is going to become mostly about real estate. It is not, Elio Motors is going to have been the exception that proves the rule. It is mainly going to become about income generating real estate. I think that's what's going to happen. But if you come from the real estate world, then these questions about even, you know, marketing is certainly an important question. But secondary markets, do we care that much? You know, these funds are going to be set up, they're going to be 5 to 7 year real estate funds. So there's a built-in exit. Yeah, we'd like liquidity, but it's not the same as it is in an Elio Motors deal. So that's a second perspective on what Regulation A can become. And then we come here to New York, and it's about, you know, finance. It's about financing companies like Elio, and when are they going to be publicly traded, and how are they going to be distributed through broker-dealer networks, and all that kind of thing. And the truth is, we don't know where this is going to end up. It can be a number, Regulation A can be a number of different things, and it can be more than one thing, and probably will be. But it is, yeah, when you think about Regulation A, just bear in mind that it's not necessarily limited to what you think it is. It can be a whole bunch of different things. Okay, Form 1A. So who in this room has ever been involved in preparing an S1? A bunch of people. Who in this room has ever been involved in preparing a Form 1A? Same people. So Form 1A is, can be a somewhat briefer substitute to an S1. On the other hand, some people just file Form 1A, they file an S1 instead because they're used to doing it, and that's perfectly fine also. So it is a disclosure document, of course, and anyone who has ever seen a disclosure document, you know, in the private placement world, they're this long, and in the Regulation A world, they're that long. The instructions to the form set forth all the stuff that you have to talk about. And the SEC is very picky about going through the Form 1A to make sure you talked about everything you're supposed to talk about and in the form you're supposed to talk about it. So for example, if the instructions say show in tabular format the compensation of the executive officers, you better show in tabular format. If you don't show it in tabular format, they will say show it in tabular format. So it can be, you know, it can seem silly at times, but you know, probably the most important part of the form is the risk factors. You need a very, very extensive and complete list of all the reasons people should not invest in this deal. An extensive description of the company's business, an extensive description of the securities, an extensive description of the offering, how the shares are going to be distributed, how they're going to be marketed, extensive descriptions of insider transactions. The SEC cares a great deal about that. The way it works in practice, of course, is that this is a back and forth between lawyer and issuer. It's very helpful if the issuer provides a lot of information in the form that the lawyer needs it. The lawyer will nevertheless probably take the information the issuer gave to him or her and revise it significantly. But it is this is not something, it's a time-consuming process, as the previous panel said. It's not, the issuer just doesn't sort of say to the lawyer, okay, prepare my Form 1A. I'm going to go do something else. Because the lawyer doesn't know what to say. He doesn't know what to say about the business and its risks and its strategies and its plans and so forth. SEC cares a lot about insider transactions, disclosing stock ownership, disclosing voting control. The SEC's overall reaction to the number of 1As that we have filed, it would be easy and is easy sort of to say, oh, they're too picky. This is silly, it's too time consuming, these are government bureaucrats, they don't really know what they're doing. But that's really, I think, from my perspective, really wouldn't be fair. In general, their comments are fair. Not always. And they do, the interesting thing to me is that there's always something. They always pick up something. So my absolutely 100% belief is that if you submitted and went through the process and got qualified a Form 1A and it was all set, and then you stopped selling it for a couple years and you resubmitted it to a different SEC examiner, they would have 5 pages of additional comments. There is some of that they have to have some comments. They care a lot about certain issues. One issue that we have found that they care about a lot is investment companies. They really want you to prove that you are not an investment company, even though it seems to you totally obvious. The SEC wants you to put in a whole section. They care a lot about asset-backed securities, has been our experience. Yes, sir.
How do they look at valuation?
They don't look at valuation. They don't care about valuation. Yes, sir.
When you say investment companies, can you just
Explain.
expound on that more?
Sure. So an investment company is a mutual fund is a good example of an investment company. A company that itself does not engage in active business, but is instead in the business of investing in other companies. And you cannot use Regulation A for an investment company. And so you'd think, from what I just said, that it would always be a very clear delineation what an investment company is and what it isn't. But that is actually not true, because there are a lot of active businesses whose business consists in some way or another of generating revenue from separate streams. For example, Doug, when he was here, was talking about this company that does games. And so I've represented companies like that. And what you have to, the SEC looks at that and says, wait a second, each of these games is a separate business. You're just an investment company. You're just owning stock in all these separate businesses, so you can't use Regulation A. So that's an example of...
In other words, your revenues are as a passive investor as opposed to...
Exactly. And so the way those companies are structured is the company is actively engaged in marketing the games.
Right.
And that's enough to get them across the...
You can structure a business so that you would want to operate different streams as different subsidiaries.
Well, and you can operate businesses in different subsidiaries. It is, I had one where it was an active mortgage company. They buy mortgages at a steep discount, they work it out, and the SEC came back, well, mortgages are securities. Okay, so aren't you an investment company? And we spent a long time dealing with that.
Is there still an exemption for business development companies, BDCs?
Do you want to answer that question, Sam? An exemption from,
You mean as an exclusion, as an, there's an exclusion for using Reg A separately, I believe.
yeah.
For that business development company.
Well-
As a line item exclusion.
So does a BDC fall into an investment company?
Not necessarily. You cannot, in addition to not being able to use Regulation A for investment company, you also can't use it for a strict blind pool.
Blank check.
Blank check. And blind pool is sometimes used incorrectly.
A BDC would fall into a blank check.
It could, yes. So if you're just saying to investors, listen, I'm really good at buying businesses, give me your money and I'll go find a business to buy, that is not a permissible Regulation A offer.
Or REIT fall into that also? Is that an investment?
No. So that's a good example. A REIT, that's what you're talking about, right? Yeah. A REIT typically is not an investment company under these arcane investment company rules, even though the REIT might own each shopping center in a separate LLC for liability purposes, that's okay. On the other hand, if all the REIT did was own minority passive interests in a bunch of other real estate companies, that would be an investment company.
REIT operates, collects checks.
Well, and it controls its assets. So one of the things that many people have thought of in the crowdfunding industry is, let me form a company, I'll take people's money, and I will select which crowdfunding deals to invest in. It's a great idea, except it's an investment company, so you can't do it. Okay, so the SEC cares about that stuff. They care about asset-backed securities. They care, we put a limited right of redemption in a deal recently, and they came back with comments about tender offers. So they don't limit themselves to the issues that you are dealing with in your filing. They're all different examiners within the SEC. There's an investment company examiner and all these different examiners, and they run the deal by all these folks. Yes, sir. Oh.
Mark, thank you. I'm curious, when the SEC staff is commenting on Form 1A and resolving these fairly arcane distinctions between what's an investment company and what is not, do you find that the resolution of that gets reflected in the final offering circular itself, or does it just get filed away in the comment letter?
It can be both. Sometimes they just want an answer from you to explain something, but on the investment company stuff, and it's kind of strange, and the asset-backed security, they actually make you put a legal discussion in the disclosure document. And I don't understand why.
You know, risk factor.
A risk factor, no, an actual discussion of what investment companies are and why.
You're not one.
Yeah, a whole like legal treatise, and I've never understood that.
However, we do not.
We are not an investment company because, but they apparently want that disclosed. So.
I think that's just, I find it's a speculation to cover their ass in a way, and also to establish liability. At the end of the day, they said, well, we didn't really understand what it was, and we have to lay it all out. It's one thing to say it's a risk factor, it can be deemed inadvertently. I think that's part of their kind of.
Yeah, frankly, I have felt in some of those situations where that I was a guinea pig, and the SEC is trying to determine what its official position is going to be on an issue, and they are using me and my client to do legal research for them. Really, and to set so that they can develop an internal policy, which is maybe good for the lawyer, not so great for the issuer. Time frame, you file these things, they promise to get back to you within 28 days of the first one. In all my filings, they have done that. And then you go through rounds of comments with them, and they promise to get back to you within 10 days after each additional submission.
It's like an S1.
Yeah, and in my experience, again, they have done that. They have stood by their time commitments. What else? What I was just going to say about filing the form. Oh yes, very important point for many people. If this is your first Regulation A offering as an issuer, you can file it secretly. It's not public. If there's some reason you want to do that, for example, you don't want to tip off competitors or something. But at some point, the filing has to be made public, and at the point it is made public, then all of the secret filings get made public too, as does all of the correspondence that you've had with the SEC and all of the advertising materials. All of the testing the waters materials gets filed. And this is actually something else the SEC cares about a lot, that testing the waters stuff. This is no less subject to SEC scrutiny than what goes between the covers of the thick book. And I think testing the waters is great, not to test the waters, but as advertising for the offering. But the SEC will carefully scrutinize what you've said in those testing the waters materials. And if you've said, this is fantastic, 15% IRR, we promise, you will not get that approved, and you'll have to go back to the public and retract it and so forth.
So the basic point though is that it needs to be consistent with the book.
It needs to be consistent with the book, yes. And I guess on that point, I will also say that, so those of you who are in the broker-dealer world know that Finra does not allow you to make projections, right? You can't advertise that 14% IRR. The same rule applies to Regulation A offerings. You cannot, even if you're a real estate developer with a great track record, you cannot advertise, we have a target 17% IRR. And in fact, I've seen taken to absurd lengths. For example, a number of the deals that we've done have had a distribution waterfall. The investors get a 12% return first, and then there's a makeup distribution. And it got to the point, so we started off saying, there's a 12% preferred return. No, can't say that. Can't say there's a 12% preferred return. We finally got to the point of just saying, this is what the operating agreement says. Investors get their 12% first. They almost wouldn't let us say that. It got to the point where they were going to prohibit us from saying what the operating agreement says, but they ultimately did. But they're very suspect on any kind of promising. So I want to talk about the accounting, the filings afterward, when they have to be made, when you have to file audited reports. Do you want to talk about that for a second, Craig?
Yeah, so that's a big part of Reg A in the consideration of whether to use it is, are you ready to be a public company? Because you are that now. The required annual reports are the 1K annual audit associated with that, along with some other discussions of your finances and other major business happenings. And then a semi-annual filing, which is another set of financial statements that do not need to be audited. Oftentimes you need a CPA involved because, as I talked about earlier, that it's not just a QuickBooks output, it's full GAAP financial statements. And then there's more Mark's territory, some limited, the equivalent of an 8K for a public company that needs to be made for major events throughout the year. So for one-man shops and stuff like that, this is things that you really need to have an active attorney involved throughout the year to know if you need to be filing these current reports, and then having your lawyers and CPAs teed up to knock out your semi-annual and annual filings when those come due.
Yeah, and there was just a very widely publicized situation where a Regulation A filer forgot to file I think their first
Their annual, yeah.
and
The word is failed.
failed. But again, and this is because these companies, these are small companies. They've never been in this world before where you have to remember this kind of stuff. So they filed.
Not true.
Pardon?
Not in that case.
Well, okay, not in that case.
No, they were a clone of a pink chain company.
Okay, so they just failed.
They knew what they were doing.
But did they know that they were forgetting?
Not doing. They have a hearing on December 6th.
Okay, so but their offering got pulled, right? They
Lucky if they don't have an enforcement act. Yeah.
okay.
They're not the poster child for the rating filing. They're the poster child for what not to do.
There you go.
Yeah.
So anyway, I think that's about it. I think we're about out of time. It is incredible. The filing of the Form 1A is an incredibly fascinating topic that we would be happy to discuss with any of you afterward. Any questions?
No, I'll let you make the point, but I mean, it's my experience with dealing with the SEC staff on these filings compared to what you go through with an S1. It's a much lighter touch, and they're very much trying to make this work well for their portfolio. And maybe too light a touch.
Well, okay, that's good. I mean, I'm glad to hear you say that.
What you're- I mean, obviously,
Yes, that has
issues
been-
they're going to be sensitive to, like investment company, or we had one together there.
Yes.
There are unique issues where they have a sensitivity. I mean, they don't want this opened up to investment companies. I mean, for a lot of reasons. But otherwise, generally, that's my experience.
Yeah, and
On the accounting side, also, they're not going to nitpick.
Agreed.
The SEC has been incredibly supportive of crowdfunding from my perspective, up into and including they just made a recent release about intrastate crowdfunding that is just very, very supportive. I have made submissions on 1As and thought they were going to come back with a whole bunch of comments because there were a bunch of legal issues raised, and they didn't comment at all. So you can never tell what they're going to pick up. They are going to pick up something. Okay, with that, thank you very much, and I guess we're ready for the next panel.